Welcome back to the deep dive. If you've listened to financial news, scrolled through any economic forecast, or maybe just looked at your own portfolio, you've certainly heard that same sort of panicked whisper about high growth assets. Is it too late?
That anxiety, yeah, it almost universally refers to one asset, doesn't it? Bitcoin. It really encapsulates that deep-seated fear of missing out, FOMO on potentially generational wealth creation. The price feels high sometimes, the volatility, well, it feels extreme, and the sheer volume of information can just be overwhelming.
That's exactly the mission statement for this deep dive today. You shared some fantastic sources with us, really powerful research from investment firms like ARK Invest and Fidelity, some intricate on-chain data analysis from Glassnode, and critical historical market perspectives. And we're going to use them to directly analyze Bitcoin's long-term value proposition right now. We really need to separate the short-term, kind of exhilarating noise of daily speculation from the long-term structural conviction that seems to underpin this whole ecosystem.
And our sources, they immediately establish this core conflict, the thing that drives this constant anxiety. It's really the difference between trying to achieve perfect timing in the market, guessing the absolute peak or the absolute bottom.
Which is impossible, basically.
Pretty much impossible, yeah. Versus simply spending time in the market, enduring the necessary volatility, but with genuine conviction in the asset's underlying fundamentals.
Right. So we're going deep today. We're looking at historical charts. We'll be dissecting some corporate balance sheets. And crucially, we're analyzing what the underlying networks are actually doing right now to gauge, well, utility. Okay, let's unpack this and maybe start with the emotional side of investing. This question, is it too late? It really is. It's almost the most cyclical and predictable thing in financial markets, especially crypto, isn't it?
Absolutely. It's a recurring narrative. It reappears every single time Bitcoin hits a new milestone or breaks an all-time high. It feels like a psychological trap, and our sources really highlight just how historically consistent this pattern is.
Yeah, it's like clockwork.
What's fascinating here, though, is that the critics and that pervasive anxiety, the whole is it too late thing, it's not unique to the current price level, wherever that might be when you're listening. If you look back, this exact fear has shown up at drastically lower valuations across, well, at least 3 distinct market cycles.
Right.
And that's really the first lesson our research emphasizes. The human response to exponential growth, it seems to be pretty much always the same. Fear and greed.
Right. So think about the emotional landscape back in, say, 2013. Bitcoin was hovering around, what, $200?
Yeah, about that.
At the time, that felt astronomical. I mean, really huge. Many thought the bubble had already peaked, especially coming off the wreckage of those early exchange failures like Mt. Gox.
Oh, yeah. Mt. Gox was a disaster.
The prevailing wisdom then was that the technology was just too fringe, maybe too complex, and definitely already too expensive at $200.
And the narrative was identical 4 years later. Jumped to 2017, remember that. Bitcoin approached $20,000.
Crazy times.
Fueled by intense media coverage. The early ICO mania. Everyone on the sidelines felt they had completely missed the boat. That period was characterized by that retail frenzy, where taxi drivers and grandparents were asking about Bitcoin.
Yeah, the classic sign.
Classic sign of a frothy top,
Yeah.
Which just reinforced the fear that the asset was already untouchable. It's run up too much.
And we saw it, again, maybe even more clearly in 2021. The asset peaked near $69,000. Each time, the collective fear, which was amplified massively by media coverage, was that the growth curve was finally exhausted, and that buying in now guaranteed you'd be the bag holder.
Yet, what these historical milestones overwhelmingly demonstrate, and this is absolutely key to understanding long-term conviction, is that despite those massive drawdowns, volatility that would scare off most traditional investors, we're talking crashes of 50, 70, even 80%.
Brutal.
Just brutal drawdowns. But the long-term holders, the infamous ho-dealers, the ones who ignored the constant stream of critics and the, frankly, terrifying daily volatility,
Right.
they have consistently seen transformative returns over time.
Right.
This really is the simple, powerful difference between conviction and speculation. Time in the market, not timing the market.
Okay, so how do we then look past that daily noise, the scary headlines, and truly understand that longer-term trend? This brings us to one of the, I think, most powerful analytical tools mentioned in the sources.
Right.
The long-term logarithmic growth chart. This isn't the standard linear price chart you usually see, right?
Exactly. It's a really important distinction. If you plot Bitcoin's history on a standard linear chart, the early days look completely flat, and the recent movements look like a vertical cliff. which psychologically is terrifying. It makes it look unsustainable.
Yeah, it looks like it's just gone parabolic and has to crash.
Precisely. However, when you view the price on a logarithmic scale, now the scale itself compresses those huge dollar movements, but it accurately emphasizes the percentage changes over time. And critically, it reveals the underlying structural trend much more clearly.
Ah, okay. I see the distinction. So it shifts your focus from like, how much money did I make or lose today, to something more like, what's the compounding growth rate been over the last 5 or 10 years?
That's it exactly. And what
Ah,
this logarithmic analysis consistently reveals is that despite those huge crashes, which, are arguably a necessary function of price discovery in a volatile new asset class, the price has always trended structurally upward.
okay.
It demonstrates that volatility is necessary, sure, but maybe temporary noise layered on top of an undeniable expanding underlying network effect and adoption trend.
Okay, so the logarithmic chart shows us the macro trend, the big picture. But how do we measure the conviction of those holders? And maybe their cost basis. That's where this critical on-chain metric comes in, right? Realized cap. This gets a bit technical, but it seems really vital.
It is vital, and it's a critical distinction that immediately moves us beyond just looking at the simple market cap. So market capitalization, that just multiplies the current, often volatile price by the total circulating supply. Easy calculation.
Right. Price times coins.
Exactly.
Yeah.
Realized cap, though, which was pioneered by on-chain analysts like Glassnode and others, it's vastly different. It calculates the aggregate value of the entire coin supply based on the price when each individual coin last moved on the blockchain.
Wait, okay, let me try and visualize this. It's like if you had, say, a massive museum collection. You wouldn't value it based on today's auction price for a similar item, but rather based on the actual historical acquisition price for every single item you bought over the years.
That's a perfect analogy,
Yeah.
yeah. It effectively measures the aggregate capital inflow into Bitcoin that hasn't actually left the system.
Yeah.
Because it ignores the short-term fluctuations of highly liquid coins being traded back and forth, it gives you a much clearer, often lower floor, a kind of basement valuation, if you will, based on the actual historical cost basis of the more patient investors.
Okay. But if that metric, the realized cap, is really high right now, doesn't that just mean that the average investor is sitting on huge profits? Yeah. Which usually signals a potential sell-off, right?
Mhm.
And how do your sources address the concern that maybe realized cap is skewed by, like, institutional whales moving massive sums around?
That's a great question, and it's why we don't look at realized cap in isolation. We use it often in conjunction with another powerful tool, the market value to realized value ratio, or MVRV.
MVRV, okay.
Yeah, this metric compares the market cap, the current value, to the realized cap, that aggregated cost basis.
Okay.
When MVRV gets really high, it can suggest the market is overheated, yes, because investors are potentially sitting on large unrealized gains relative to their entry price. However, analysts also look for sustained MVRV ratios that stay comfortably above 1.0. That suggests the network is generally healthy and the average holder is in profit, which incentivizes holding. But more importantly, the stability and the gradual expansion of the realized cap itself, even during price crashes, that confirms that a massive amount of capital is deeply embedded and isn't just speculative hot money.
Right, it hasn't fled the scene.
Exactly. That embedded capital forms a sort of psychological floor for the true strong hands, the long-term holders who likely won't sell unless the price falls significantly below their own acquisition cost, below their piece of that realized value.
Okay, that clarifies the mechanics quite a bit. So understanding these historical cycles, the psychology, and these deeper metrics like realized cap, it tells us that the fear of missing out seems kind of baked into the asset's DNA, but historically, conviction and patience have been, well, overwhelmingly rewarded.
That's the historical lesson, yeah.
Okay, let's pivot then. Let's move sharply from market history and psychology to the foundation itself. What actually gives Bitcoin its fundamental, verifiable value proposition?
Well, any discussion of Bitcoin's long-term value, the thing that really fuels the conviction we were just analyzing, it has to begin and arguably end with its defining characteristic: absolute, verifiable, and programmed scarcity.
The ultimate supply constraint. We hear this number constantly, 21 million, but it's worth stressing the sheer finality of it, and maybe the sociological implications too. Only 21 million BTC will ever exist, period.
Right. That limit is programmed directly into the core code. It's essentially immutable unless there's overwhelming global consensus to change it, which is incredibly unlikely. And that finality is fundamental to its appeal, especially as a potential hedge against global monetary inflation, where fiat currencies don't have that guarantee.
Yeah, it's the crucial difference from almost every other asset class, isn't it? Unlike predictive fiat currencies, which, can be printed seemingly indefinitely at the whim of central
Oh,
banks.
quantitative easing, yeah.
Yeah. Or even something like gold, which theoretically has an unknown quantity still hidden deep in the earth, or maybe even asteroids someday, who knows?
Right, the supply isn't perfectly known.
But the hard limit of 21 million Bitcoin is a known, mathematically constrained certainty. This is what attracts those high-conviction investors, especially institutions. They trust the scarcity because it's guaranteed by code and distributed network consensus, not by some shifting governmental policy or a new mining discovery.
Exactly. Trust the math, not the politicians, essentially.
And that scarcity isn't just a static number, it's constantly reinforced by a programmed, predictable supply shock mechanism. We have to talk about the halving.
Yes, the halving. This is arguably the single most important long-term driver of the asset's value, and it's repeatedly detailed in the research we looked at from firms like Fidelity.
So what is it exactly?
The halving is a deliberate algorithmic event. It occurs roughly every 4 years, or more precisely, every 210,000 blocks mined on the blockchain. Its purpose is brutal in its simplicity. It cuts the block reward in half.
And the block reward is...
That's the amount of new Bitcoin created and automatically given to the miners for successfully adding a block of transactions and securing the network.
Okay, so let's put some numbers on that to make it concrete. When Bitcoin first launched, the reward was 50 BTC per block.
Correct. Quite generous back then.
Yeah. Then the first halving cut it to 25 BTC. The second cut it down to 12.5.
Right. And the third halving, the one in 2020, cut that rate down to 6.25 BTC per block. The next halving, expected around spring 2024, is programmed to reduce the rate again, down to 3.125 BTC per new block.
Wow. So it's a compound exponential reduction in the inflation rate of new Bitcoin.
Exactly. To be clear, it doesn't affect the existing supply already out there, but it dramatically and continually reduces the rate of new supply entering the market. It makes new Bitcoin harder and harder to mine.
So it's like a continuous pre-scheduled tightening of the belt, isn't it? It ensures that the asset becomes exponentially harder to acquire over time, assuming demand even just remains constant. It just builds this constant pressure cooker under the supply side.
That's the key takeaway from the sources on this. If demand remains constant, or more likely, increases, and we'll definitely get into the institutional demand side later, while the rate of new supply generation is programmatically cut in half, well, basic supply and demand economics dictates that upward price pressure must eventually follow, all else being equal.
Right.
This mechanism makes Bitcoin arguably the only truly predictable scarcity asset in human history. You know exactly when the supply shocks are coming. Kind of, yeah. Its primary function, however, at least as perceived currently, is increasingly recognized as a non-sovereign store of value, a place to park wealth outside the traditional system.
And perhaps most relevant in today's environment, with global instability and bouts of high inflation, it's fundamentally viewed by many as a potential hedge. This is where the comparison to traditional time-tested assets like gold becomes really crucial, doesn't it?
It does. And the sources specifically recommend comparing Bitcoin's performance directly to gold over the last decade or so. For millennia, gold has been the ultimate inflation hedge. It's tangible, it's relatively rare, difficult to confiscate easily, and hard to move in bulk.
The standard.
It's the historical standard. However, modern investors, especially younger demographics and institutions looking for efficiency, increasingly see Bitcoin as potentially the superior hedge for the digital age. It's digitally native, globally transferable almost instantly, highly divisible, and arguably more censorship-resistant in certain scenarios.
And the performance comparison.
Well, its performance over the last 10 years certainly supports the argument that it has successfully fulfilled some kind of modern digital store of value role. It has often significantly outperformed gold in percentage terms during that period, though with much, much higher volatility, of course.
Of course. Okay, so the foundation seems solid. Unbreakable scarcity enforced by the halving, coupled with its increasing recognition as reliable, secure digital property or a store of value. But the market landscape itself has changed dramatically since the last cycle, hasn't it? It's clearly no longer just a retail phenomenon. Let's talk about who is buying it now and how that changes the long-term outlook.
Yeah, this is maybe the biggest differentiator between the current market phase and, say, 2017 or even 2021. It's the foundational shift driven by regulatory acceptance, or at least steps towards it, and the resulting massive institutional interest. This really marks the transition away from Bitcoin being seen as just a purely retail, almost hobbyist asset.
Wall Street has definitely joined the game. And the source material heavily emphasizes the, well, almost earth-shattering significance of the spot Bitcoin exchange traded fund ETF approvals, particularly in the US.
Huge news.
That was such a critical regulatory step, wasn't it? It signaled not just interest, but finally mainstream accessibility and acceptance. It makes it incredibly easy now for traditional financial advisors, pension funds, large institutional trading desks to gain liquid exposure without the perceived technical risk or burden of holding the actual Bitcoin themselves.
In this transition, it's more than just enthusiasm. It's become a structural necessity for these really large-scale players. I mean, institutions manage trillions in assets under management, AUM. They cannot practically go out and buy billions of dollars of a commodity from various, sometimes unregulated crypto exchanges.
Right, compliance nightmare.
Exactly. They require regulated, easily tradable, familiar products that fit into their existing workflows and compliance frameworks. So the involvement of these major, traditionally risk-averse institutions cited in the sources, we're talking firms like BlackRock, the world's largest asset manager, Fidelity, and then on the corporate treasury side, MicroStrategy, their participation is now fundamentally driving the trend.
MicroStrategy is so often cited as the ultimate, very public case study in corporate conviction, aren't they? Their strategy has just been relentless accumulation.
It really has. They've leveraged debt, issued equity, specifically to continuously add to their Bitcoin reserves. They've effectively turned their company, in large part, into a Bitcoin-backed treasury vehicle.
It's like the ultimate proof of long-term belief, particularly in the Michael Saylor thesis about digital energy and property.
Absolutely. Their former CEO, Saylor, has very publicly argued that cash held on a balance sheet is essentially a depreciating asset, constantly losing purchasing power to inflation. And therefore, in his view, Bitcoin is the only suitable treasury reserve asset for a truly forward-looking corporation in the digital age.
And their holdings now, the source data puts it where?
Citing the source data we reviewed, their holdings now stand at well over $18 billion worth of Bitcoin. It's a staggering amount for one company.
Wow. That level of corporate balance sheet allocation, that's clearly not short-term speculation. It demonstrates a profound, high-level conviction in the asset's future, potentially as a foundational digital currency standard or store of value.
You simply don't make bets that large on your corporate treasury if you're thinking short-term.
Right. And that corporate accumulation, plus now the ETF inflows, it must have a direct, profound impact on the supply dynamics we discussed earlier with the halving. When institutions start accumulating at this scale, they're essentially removing liquid supply from the open market, aren't they?
That's the critical loop mechanism that's now potentially at play, yes. The more institutions acquire and then sequester BTC, often moving it into long-term high-security custody solutions or cold storage vaults, the less Bitcoin is actively available for trading by retail investors and short-term speculators on exchanges.
So the free float shrinks.
Precisely. This absorption rate, especially accelerated post-ETF approval, where you have giants like BlackRock potentially buying huge amounts daily to meet ETF demand, it systematically reduces the free-floating supply available for trading, which inevitably creates further scarcity pressure. Basic economics again.
So institutional demand isn't just a separate driver alongside the halving. It actually seems to amplify the effect of the programmed halving. You've got supply reduction meeting potentially relentless, deep-pocketed demand.
Exactly. It creates a dynamic where even a relatively small increase in net demand could potentially result in a disproportionately large change in price, simply because the available supply on the sell side is becoming so thin, so inelastic. The order book depth might be shrinking.
Okay. This shift isn't just confined to corporate boardrooms and Wall Street trading desks either. The sources point out we're seeing real, actual governmental conviction in some places too. Let's look at the unique example of El Salvador.
Ah, yes, El Salvador. It serves as a really unique and frankly powerful case study in global adoption, whatever you think of the politics or the execution. Their decision back in 2021 to adopt Bitcoin as legal tender alongside the US dollar. It highlights a real-world governmental conviction in its financial utility.
Not just as an investment.
Not merely as an investment vehicle, no, but as a potential practical currency, a tool for cheaper remittances, which are huge for their economy, a way to bank the unbanked, and perhaps a strategic hedge against dependence on the US dollar, giving them maybe a degree of financial sovereignty they didn't have before.
That decision, regardless of its immediate success or challenges, It certainly signals to the entire developing world or the global south that Bitcoin can function, potentially, not only as a store of value like digital gold, but also maybe as a verifiable medium of exchange or at least a settlement layer at a national level.
It opens the door to that possibility, yes. And the combination of Wall Street acceptance through ETFs, deep corporate convictions shown by MicroStrategy, and this kind of sovereign adoption experiment in El Salvador.
Mm.
It truly changes the risk profile and the long-term trajectory compared to past cycles.
Yeah.
It fundamentally provides important context for that recurring anxiety over, is it too late? When you see a foundational technology potentially moving from being a fringe retail novelty to becoming a globally adopted institutional and even governmental asset, well, the time horizon for the investment fundamentally shifts from thinking about months or the next cycle to potentially thinking in decades.
Right. It reframes the whole question. Okay, now, in the spirit of a proper deep dive, we absolutely must maintain balance here. Our source material is very clear that this massive potential reward we've discussed comes with significant unavoidable risks. We can't offer a comprehensive analysis without detailing the necessary skepticism and the potential downsides.
Absolutely crucial. And the most immediate and obvious risk, historically speaking, is the volatility. We have to relentlessly emphasize the historical precedent of extreme price swings.
It's not for the faint of heart.
Definitely not. The research clearly shows that Bitcoin can, and often does, drop 50% or more during a bear market cycle. We saw, 80% drawdowns from the 2017 peak and nearly 70% from the 2021 peak. Investors absolutely must be mentally and, frankly, financially prepared for that level of drawdown, regardless of how bullish the long-term outlook might seem.
Yeah, managing that risk is key. Beyond just price volatility, there's the ongoing and maybe increasing regulatory uncertainty. This can significantly impact the environment, especially for those institutional holders we just talked about. Governments around the world are still figuring out, developing, and in some cases, actively enforcing their stance on crypto.
Yeah, the regulatory landscape is still a patchwork, and that's a major risk factor. This kind of breaks down by jurisdiction. On one hand, you have potentially comprehensive frameworks emerging, like the EU's MiCA the Markets in crypto assets regulation. Now, while it's restrictive in some areas, it at least offers clarity and a single set of rules for 27 member states, which could actually aid institutional adoption in the long run by providing certainty.
Right, rules of the road.
Exactly. On the other hand, the United States has generally adopted a more piecemeal, often enforcement-focused approach. You have various agencies like the SEC and the CFTC sort of staking claims over different aspects of crypto, which creates persistent legal uncertainty and potential conflict.
Yeah, the regulation by enforcement critique.
That's the phrase often used, yes. This regulatory flux remains a significant risk. Sudden adverse policy moves, new rules, or major enforcement actions could easily disrupt accessibility, dampen institutional enthusiasm, or impact specific parts of the ecosystem.
Okay. And then there's opportunity cost. This is a crucial, often overlooked risk for any investor, isn't it? When you tie up capital in the established blue chip like Bitcoin, you always run the risk of potentially missing out on higher percentage returns elsewhere.
This is critical, especially when we're dealing with a relatively younger, fast-moving asset class like digital assets overall. Specifically, our sources do mention alternative options that might outperform Bitcoin, at least in certain market cycles. For example, smaller, high-growth altcoins. They can sometimes offer much higher percentage returns.
But with way more risk, presumably.
Oh, vastly increased risk, absolutely. Many go to zero. But the potential for outsized gains exists there. Secondly, you have the rapidly emerging world of DeFi, decentralized finance. These projects offer complex mechanisms like yield farming or liquidity providing, potentially generating higher returns or yield than simply holding Bitcoin, though again with significant smart contract risks and complexities.
And what about this idea of tokenizing traditional assets, real-world assets?
That's the third potential competitor for capital. Real-world assets, or RWAs, being tokenized and brought onto blockchains. This whole sector aims to bring assets like, say, fractional ownership of real estate, private equity stakes, or even commodities like gold or carbon credits onto the blockchain.
Okay.
This could potentially offer the security and transparency benefits of digital ownership combined with the more predictable, or at least familiar, return profiles of traditional finance. If the RWA sector really takes off, significant capital might flow there seeking both blockchain benefits and exposure to traditional markets, potentially causing investors holding only Bitcoin to miss out on those diversifying returns.
So lots to consider on the risk side.
Okay, let's turn back to the on-chain data again for a moment. Let's check the market's pulse beyond just the price chart and institutional flows. If institutions are buying, what does the network activity itself tell us about genuine utility growth? Is it actually being used more?
Yeah, looking at on-chain activity trends gives us objective evidence of adoption or lack thereof. We monitor core metrics like the number of active addresses on the network daily or weekly, and the total transaction volume or the value being settled on the chain.
Why are those important?
Well, if the price goes up significantly, but these fundamental usage metrics stagnate or even decline, that might indicate a purely speculative bubble, somewhat detached from underlying utility. However, if the price rises alongside expanding network use, meaning more people or entities are actually using the network for transfers, for storage, for security, that suggests more genuine, organic, utility-driven growth is happening. That makes sense. And what about efficiency? One of the major historical criticisms of Bitcoin, used constantly by detractors, was always the speed, the cost, and the capacity limitations of the main Bitcoin blockchain, the base layer.
A very
Right.
valid criticism for a long time, yes. And that's precisely where the adoption and the growing usage of second-layer scaling solutions becomes so incredibly important, specifically the Lightning Network.
Right, Lightning, how does that help?
The Lightning Network is designed specifically to handle instant or near-instant, very low-cost, often near-zero-cost microtransactions off the main Bitcoin blockchain. It works by creating temporary payment channels between users or hubs.
So it takes the load off the main chain for small stuff.
Exactly. It allows for potentially millions of transactions per second across the network rather than the handful per second the base layer can handle. So increased Lightning adoption and volume show that the network is successfully scaling its utility, directly addressing that key historical weakness, and proving its potential viability as a global medium of exchange, at least for smaller, everyday purchases.
Okay, so if the underlying utility is arguably growing, or at least the infrastructure for it is improving, and institutions are clearly buying, this leads us to the projected maturity of Bitcoin as an asset class.
Hmm.
The research you shared suggests a potential shift toward what they call blue chip status. What does that mean?
That's kind of the long-term outlook summarized in a term familiar to traditional investors, yeah. The idea is that Bitcoin, having survived multiple cycles, gained regulatory clarity via ETFs, and attracted institutional capital, has maybe achieved a certain critical mass. While it may perhaps never again deliver another 100x return from its current kind of valuation, the numbers just get too big. Its role might be shifting.
From disruptive upstart to.
Exactly. Moving away from being primarily a potentially high-reward speculative outlier into becoming a more stable, established blue-chip digital asset. It might have earned its status as the foundational digital layer, the most secure, the most decentralized. And that stability, even if it comes with slower, massive percentage growth compared to its early days, that could be the ultimate long-term value proposition for many investors. Security, established permanence, digital scarcity you can rely on.
Interesting. So if it's becoming established and the liquid supply is shrinking due to AJ-laying and institutions, who is actually holding the supply right now, we need to profile the holders to see who's potentially left to sell during downturns.
Yeah, examining wallet distribution data helps us understand the market structure and the level of conviction. On-chain analytics firms allow us to contrast the percentage of Bitcoin held by long-term Yejo dealers, often defined as addresses that haven't moved their coins for, say, over a year or even longer, the so-called strong hands, versus the generally smaller percentage held by short-term speculators or traders, addresses that show high activity. Glassnode data, for instance, consistently shows that when the supply held by these long-term HO dealers is high, sometimes exceeding 70 or even 75% of the total circulating supply, it indicates that the liquid supply, the amount readily available for purchase on exchanges, is extremely low.
And that conviction is strong among the majority of holders.
Exactly. This structure tends to minimize the risk of massive sudden sell-offs driven purely by retail panic, because most of the coins are locked away by holders with a long-term thesis. It also means that new institutional inflows, like from the ETFs, immediately encounter quite intense scarcity, potentially amplifying their price impact.
Okay, so the sources are essentially telling us that the asset is being progressively locked up, both by the programmed code through the halving mechanism reducing new supply, and by the conviction and custody requirements of long-term individual, corporate, and institutional holders reducing the available supply.
That sums it up pretty well, yeah. The narrative of "is it too late" often seems to ignore these powerful converging structural forces: the programmed scarcity, the verifiable utility growth on layer 2, the accelerating institutionalization, and the deep-seated conviction shown by the majority of holders. that collectively seem to define the long-term upward trend despite the significant volatility along the way.
I'm back.
Hashtag tag outro. This has been an incredibly detailed deep dive into the source material you provided. We started with that almost universal anxiety of FOMO. Is it too late? And I feel like we've systematically broken down the long-term thesis for Bitcoin using hard data, historical context, and current trends.
Yeah, I think we've established three main sort of non-negotiable pillars that the sources point to supporting Bitcoin's potential long-term value. First, there's the undeniable historical precedence, which really shows that deep conviction and time in the market have historically outperformed attempts at perfect market timing.
Second, there's the unwavering scarcity, enforced programmatically by that 21 million hard cap and the compounding halving cycles reducing new issuance. And third, there's the accelerating institutionalization, driven by major Wall Street firms like BlackRock, Fidelity, and corporate players like MicroStrategy, which is fundamentally changing the supply-demand dynamic by locking up more of the remaining liquid supply.
Okay, so our final synthesis really revisits that core anxiety we started with. The detailed analysis we've walked through, based on your sources, it seems to definitively shift the focus away from trying to perfectly time the next cyclical peak or trough and directs it more towards recognizing the deep structural, technological, and regulatory factors that appear to be driving the asset's overall long-term trend.
Exactly. If you believe fundamentally in the future utility and value proposition of decentralized, digitally native, scarce property, well, then the question maybe isn't so much about perfect timing, which is likely impossible anyway. It's more about acknowledging the potential long-term trend and deciding if and how you want to acquire some time in this market.
Right. It's a different framing.
And as we wrap up this deep dive, we want to leave you, the listener, with one final, perhaps provocative thought, something to maybe mull over as you process all this data. We spent a lot of time today discussing Bitcoin's potential transition to becoming digital gold, a stable store of value, a hedge against inflation. But what if its ultimate role is actually far bigger than simply being a better digital version of gold?
Okay, go on.
Consider its true potential, especially based on the growth of scaling solutions like the Lightning Network, and its established status as arguably the most secure, most trusted, most decentralized base layer in the entire crypto ecosystem. Is Bitcoin permanently entrenched as merely digital gold, destined to just sit inertly in vaults and portfolios as a hedge? Or is the current wave of institutional hype and adoption perhaps just the very beginning of its true evolution into something much more profound? Could it become a foundational global settlement layer, maybe acting as a neutral reserve asset for the digital age, the secure, censorship-resistant backbone for the entire future decentralized digital economy? That ultimately seems to be the grander scope of the conviction we're seeing reflected in some of the long-term source material. Food for thought.